How's it going, guys? This is Forensic Forex with Deontay, and I'm back with another video. This is episode 42 to the Asian Session Library. Once again, the same pair, US dollar versus Japanese yen. We had a successful Asian Session model on Wednesday night, the 6th, March 2024. Let's walk through it together. We are not permitted to trade between 12 p.m. to 8 p.m. Why is that? Because the market is building in market sentiment. Buy stop orders and sell stop orders are accumulating here. There's a consolidation that tends to happen within this time period. So we're not going to look to trade. However, we're going to take those buy stops and sell stops that are forming above highs and lows to give us an idea to frame a trade idea during the Asian kill zone. This is a live zone because this is where we're looking to buy the market or sell the market or find some type of feasible setup. We have no swing low in that night's example. We can see we'll have to take the lowest low that forms here on the 15-minute time frame as our sell side liquidity. Everything else, we have buy side liquidity above the swing highs that are unbroken. Playing it forward, let's see what happens. Price takes out and purges the sell side. At this point, we would be on guard or would be stalking for a 1-minute setup. I like to go down to the 15-minute, down to the 1-minute for the entry technique. You can see as well, we're below the Asian session opening price. If you take a look after breaking that low, there we are. We're in a discount. So our thinking should be, are we looking to sell in a discount or are we looking to buy in a discount? We're looking to buy in a discount because it's more ideal. Giving the framework of taking out sell side liquidity, purging it, we still have buy side liquidity available for price action to run. We have many clean highs that price action could potentially draw to. Doesn't mean it's guaranteed, but we're trying to frame some type of idea here. We're going to be looking for a specific entry technique. That entry technique is going to be a fair value gap that runs to a swing high, and that swing high needs to reside inside the fair value gap. Let's play it forward. Playing it, and there we go. We have a fair value gap. We'll zoom in. There goes your fair value gap that runs a swing point, and the swing point is residing inside the fair value gap. It's right there. It's the same entry technique I've been showing you guys for a handful of episodes now. The same sequence, breaking a swing low or breaking sell side liquidity, and then making a fair value gap to the upside, and that swing high is residing inside of that. We're looking for a one-to-one scenario. So we're going to be looking to go long at the premium side of that fair value gap. So 15 pips for 15 pips, just like that. And we're risking anywhere from 1%, 2%, 3%, and whatever your risk appetite is. And we're looking for projection higher. So that's 15 pips to the upside there. So we're looking to see if price is going to run up and give us 10 for a scale out or taking partials, and then 15 pips higher. There we go. So we have price running up, giving us 10 pips. We can scale out, and there we go. Full TP hit. Now, if you don't pay the trader, it can come back to haunt you. If you are not taking partials or you're not collapsing your trades or taking something off the trade, it will come back to haunt you because you'll see later in this session, look what happens after we get that TP hit. Let's say you didn't take partials and you didn't have a take profit. You would be stopped. And that would be very upsetting, right? Yes, price did not return back to those buy side liquidity pools, but it was a potential draw. We can see how these levels could have been a projection if this trade were going to go higher. It could target these clean highs or these relatively equal highs where buy side is residing from. But we can see the market had other plans to go lower. But all in all, that session was successful. And the sequences, it raids the sell side liquidity, it creates a fair value gap that runs the swing high, and the swing high, I'll repeat again, the swing high is inside the fair value gap. It's not on the beginning of the fair value gap or the end. It's in between the 2 points. It has to be somewhere within those 2 points. It can't be on the same level where the fair value gap starts and ends. Hopefully you found this insightful. Peace.